if it sounds too good to be true, it probably is. We never pressure LPs to make a decision. People were getting mortgages under 3%, and they kept saying, yeah, it's historically low, but they seem to have forgotten what does historic mean? It doesn't mean normal. It means unusual. I want to know what's going on with my property, good or bad. I've been in real estate 40 years. It's created a great life for me, but it didn't happen in 5 years. It may not even have happened in 10. But I would say...
Investment operators, welcome back to the Invest Clearly podcast. I'm the CEO of Invest Clearly, Pat Zingarella. In today's GP episode, Chief Strategy Officer of Invest Clearly, Joe Guidi, sits down with Arn, founder of Spark Investment Group. Arn shares how his experience as a real estate agent and single-family investor have shaped his approach to multifamily syndications. They discuss how he evaluates market shifts, structures returns in today's higher rate environment, and communicates with LPs during hold periods. He also shares how he's thinking about alignment, risk, and adapting to changing investor expectations. Let's get into it. The views expressed in this podcast are those of the individual guests and do not reflect the opinions or recommendations of Invest Clearly. This podcast is for informational purposes only and should not be considered investment advice. The appearance of a sponsor or investor on this show does not constitute an endorsement or a warning. Invest Clearly is an objective and neutral platform. Always do your own due diligence before making any investment decisions.
Arn, thanks for joining me.
Yeah, Joe, thanks for inviting me. Looking forward to our chat.
Yeah, me too. I'm really looking forward to it. I love the approach you guys are taking, especially from the education perspective. We'll get into that in a minute. But before we get started, would love for you to just talk a little bit about who you are, what you do for listeners who may not be familiar with you.
Yeah, so I've been in the real estate business since 1978. So I think if I add those years up, it's 47 years. Started as a residential broker in Palo Alto and Menlo Park, California, basically Silicon Valley. Did residential real estate there for 35 years. Started to build a small rental portfolio because way back then you could actually buy stuff in the Bay Area that would work as rentals.
Sure.
Then had the good fortune to start investing in Austin, Texas after 2000. And I think most of your listeners know what's happened in Austin. About 10 years ago, Laura and I moved across the country to Greenville, South Carolina, kind of a lifestyle transition, a new adventure, if you will. And then about 5 years ago, moved to multifamily. So I'm now a multifamily syndicator, operator, sponsor, whatever term you'd prefer to use. Our market is Greenville, South Carolina, and we just recently completed our syndication acquisition.
Awesome. Yeah. So why the shift from residential brokerage to syndications?
Yeah. So, one, I think I just wanted to learn something new. It's still residential. I'd been in the residential real estate all my life. I didn't jump from single family to office or industrial. It's kind of a natural, logical step to multifamily residential. Clearly an affordability issue in the United States. Apartments are one of the most affordable housing options for many people in America. And so I think there's strong demand there. And frankly, there's a limited supply, there's an undersupply. So I think the dynamics, the economics of supply and demand set up well for long-term investing in apartments. The other thing I would say is single family vesting is maybe more of a solitary experience. Of course, you might have a property manager and you work with brokers and things like that. Where with multifamily, it's kind of more a team effort. And frankly, I enjoy the partnership with my colleagues, kind of working together. And so multifamily allowed me to partner with some folks that had skills that I didn't have, that were better at certain aspects of the business than I was. And that, of course, then allowed me to kind of focus on what I do best, which not coincidentally is what I enjoy best. Funny how that works, right? You're good at you're good at the things you enjoy doing. So really like the team aspect of it. And I think it's a good long-term economic investment. I think the final point is we treat our residents as our most important customers, and we try to provide them a quality living experience in return for rent. And they work hard, they deserve a good place to live. And so when we acquire assets, we generally improve the communities, upgrade them. We want to provide nice, safe, affordable housing for people who need it. And we're local. And so as we turn these buildings over, there is some sense of helping our community and community improvement. So those are some of the factors that led me to go to multifamily. Still have a few single family investments, but I've kind of gone all in on multifamily.
Okay, cool. So that's yeah, I love the community approach and totally see what you're saying about the team effort there. Um, in the shift to syndications, obviously a lot of this podcast is about and our audience is LPs, right? The whole site is geared around LPs and trust and kind of transparency. The shift from single family investing to like doing syndications and bringing LPs, walk me through that. Like how that must have been a new experience for you for the most part.
Oh, yeah, it was definitely a new experience. And a local investor friend of mine, young guy, much younger than me here in Greenville, called me up March of 2020. And if you recollect back, that's about the time we understood COVID was actually a huge deal. And he asked me, hey, Arn, what do you think is going to happen on rent collection? And I said, well, I don't know. I got my March rent. Talk to me in April. But at the end of the phone call, he turned me on to a podcast about multifamily investing. So literally that kind of caused a light bulb to go off. I started consuming podcasts like yours, went to a few conferences, and actually had two different mentors. So even though I had 40 years in the real estate business, I understood multifamily was something a little bit new. I entered two coaching programs. They both provided me something different. And that's how I kind of involved in it. And I could tell you our first deal, we bought it May of 2021. Not a huge deal. It was about $2.8 million, 43 units in Greenville here, maybe 20 minutes from my house. And we had to raise $1.5 million. And my partner, Brian, and I, we didn't know we could raise $1.5 million. We thought we could raise $1.5 million, and we did. And that kind of gave us our start. And I kind of switched to it early 2020, didn't acquire my first asset till early 2021. One was taking the time to kind of educate myself. But number two, I also recognized I wasn't the operator. I'm more the hunter, the deal finder, the networker. And I knew my partner, Brian, because I turned my rentals over to him. He's the property manager, asset manager. And until I could take that step to buy my first deal and ask people to invest money with me, I had to know, I had to have confidence that I had the operational aspect nailed. And Brian has 15 years now of property management experience. Prior to that, 15 years as a master plumber. So he knows his way around construction sites. So, and I think a recurring theme in the syndication market now is, I'm sure many of your listeners have heard of deals that haven't gone as well as they would have hoped. And I think what that's bringing home is the real importance of being able to operate these assets professionally. That's been borne out. And so got Brian on board. We looked at 4 or 5 properties. We finally found one we both like, and we took the plunge. And now we've completed eight syndications, but that was our first.
Yeah, that I think you're totally right about that. I mean, we certainly hear stories of operations being the challenge, and I think that has come to light in the industry in general, especially as so many have gotten into it quickly. And there seemed to be a little bit of a fever pitch for a while on acquisitions, uh, if that's a good way to put it.
Yes, and there was a perfect storm 2019, 2020, and our reaction to COVID, uh, the political decisions made to kind of shut down the economy, which then led to decisions to bring interest rates basically to zero to keep
Right.
the economy afloat. And, we kept saying, these are historically low rates. People were getting mortgages under 3%. They were buying multifamily at 3.5. And they kept saying, yeah, it's historically low, but they seem to have forgotten, what does historic mean? It doesn't mean normal. It
Right.
means unusual, right? And so people got into the game maybe with limited real estate experience. The rapid decline in rates and cap rates created a situation where you could buy apartments profitably, even if you didn't have any idea what the heck you were doing running these assets. And
Sure.
now I think we've returned to a more normal market. When I bought my first house, I paid 11.75% interest rate. So 5.5 interest rates don't scare me. That feels more normal than 3.5. And so operations and a little bit more of a long-term perspective, as opposed to flipping buildings every 2 years, that isn't really real estate investing. And so investing's more long-term. And where the operations come in is if you can increase your rental income 2 or 3%, you can reduce expenses 3 or 4% by working efficiently, knowing what you're doing, moving quickly. That creates the margin for a now profitable investment in a normal market where interest rates are basically flat. So it's been an interesting transition. And I know some LPs have gotten hurt, and I feel badly about that. And again, it's a matter of educating people about real estate investing, not overselling it. To me, I think if I was an LP, had a pretty nice, uh, good paying job, professional level status, making good money, my goal, and I was 35 years old, my goal might be in 10 or 15 years, get to the point where maybe I become work optional. I think a 10 or 15-year plan with systematic real estate investing can create that. Unfortunately, we had a lot of gurus trying to sell the idea you could do it in 2 years, and it's just not realistic. But long-term steady investing, I think in 10, 15 years can create financial
Sure.
security and freedom.
Get rich slowly, right? That's what
Get,
they.
get, get, get rich slowly. And then the other thing is, you don't have to be the smartest guy in the room. If you just go into these deals properly, and for me, what that means is relatively low leverage, fixed rate debt, have ample cash reserves for when Murphy's Law hits,
Sure.
and have some operational ability. And at that point, if you have a 7 to 10 year time frame, you're almost certain to win. So I would ask your listeners, does anybody in your audience believe the price of housing 10 years from now will be less than it is today? I would almost see that as an impossibility. So again, if you set it up right and are able to ride out the ultimate downturns, you're going to come out the other end and you're going to win. And generally in my career, I've kind of seen real estate goes up 6, 7, 8 years in a row. There's a year or two of decline, a year or two of flat, which then just sets the plateau for the next 10-year run up. And if you just get through that 1 or 2 years of a little bit of turbulence, you're going to be fine. And that's kind of our approach at Spark.
Well, I think we could go real long on that topic. So
Okay.
let's so I want
Yeah.
to circle back though
Yeah.
to this kind of new, kind of again, you're coming out of single family, you're starting to do syndications, you're bringing in this new constituency into your world, which is the LPs, right? So you go out into raise your, I think you said 1.2 million for the first deal, and now you presumably you did that, and now you've got this new group of people interact with. You always had the tenants. You probably had some managers that you had to work with, but now you've got this new group of people. Talk to me about what interacting with them, finding them, like what is your approach to LPs?
Yeah. So, it's a great question. And so, uh, I came from a real estate background before I went into the multifamily space. And so I had a pretty loyal client base back in the Bay Area. So that was one group that I touched about multifamily investing. My partner, Brian, here in Greenville has Progressive Properties of Greenville, maybe 500 houses under management. So he has a client database that knows, likes, and trusts him. So we tapped that. Uh, so those were two avenues that kind of were ready made for us to kind of work on. And then the other part is we're very active, particularly me on social media. So I do a lot of Facebook posting, a lot of LinkedIn posting. A lot of it is educational content, and a lot of it's about Greenville. So uh, my brand has kind of become Greenville, South Carolina. So my name's been connected to that. And as we're doing all this, I'm networking with local real estate people. And that's kind of how we did it. And then the other thing, I built my residential brokerage business largely on referrals. And so that's a similar process that's happening here. So we attracted that initial group of investors. I think it may have been about 30. We did a great job for them. 6 months later, when we had another deal, they invested, and maybe they brought one or two of their friends along. And so we're building the network that way. But social media is a big part of it. I've actually acquired property as large as 38 million basically on my social media contents and regularly posting. So we have a monthly newsletter that goes out to all of our investors. In addition, we send a monthly newsletter on each property to that specific investor group. We're a relatively small group. I think now we have maybe 13, 14 million of capital invested. And all of our investors have access to the three principals, Arn, Dan, and Brian. And I think that helps because the investors can reach out and actually talk to somebody who's intimately connected with the deal.
Yeah, definitely. I mean, I think access is really important, especially early days. So are most of your LPs, are they first time investing in a syndication, or they have experience?
I would say a large percentage of them are first time. Um,
Okay.
so we always do, at least to date, we do 506B deals, which for
Okay.
your audience, I'm sure they know, but to fill them in, is open to accredited investors, but also so-called sophisticated investors who are not accredited, but have the financial knowledge and income stability to kind of properly evaluate the suitability of any investment for them. So we do 506B. The other thing we do, our minimum is 25,000. Our deals are relatively small, or average acquisition is maybe $5 million. So our raises are maybe typically 2.5. So the 506B model really works well for us. And the $25,000 entry point really allows those first time investors to get in. And, let's be frank, it's a little scary writing somebody a check for $25,000, $50,000. Basically, as a limited partner investor, you're kind of turning it over to the general partner. The general partner's in control. So I think to the degree you can minimize the barriers to entry, give people an opportunity to test it and see if they like it. And one thing I always talk to people on my LP calls is, look, you don't have to go all in on your first investment. If you have 150,000 to invest, maybe split it up into 2, 3, 4 deals, and then see who does what they said they're going to do and who doesn't, who communicates with you, who's accessible, whose property is performing at projections, who are meeting the promises they made when they sold the investment to you. So I like people being able to test the waters, find operators they like, and go from there. So don't go all in your first. Do it in little bites. Make sure it's right for you. And if you like it and you find people you love to work with, then you can invest in their subsequent deals.
Yeah, that makes a ton of sense.
This episode of the Invest Clearly podcast is brought to you by Scale IR. If you're raising capital, you know the hardest part isn't just generating leads, it's turning those leads into committed investors. That's where Scale IR comes in. Scale IR transforms your investor engagement process with their proven solutions that optimize lead qualification, accelerate investor conversations, and drive higher conversions. From seamless CRM integration and intelligent workflows to expert investor qualification specialists who handle your initial discovery calls, Scale IR gives your team freedom to focus on closing deals. If you're ready to scale your investor relations and capital raising effectiveness, visit scaleir.com to learn more and book your strategy call today. Scale IR. Engage smarter, convert faster.
It sounds like, so if I'm back up a little bit, it sounds like your initial group of investors mostly came from your network, right? They know you, they trust you already. Same with your partners. And then you've got a significant number of referrals coming through because you're performing, your LPs like you, and so that trust kind of transfers. I mean, that's what we find, early days. That's, I think, how all syndicators start. But you also have a huge social media presence. You're out doing a lot of education. LPs coming to you organically as well? People that haven't invested with you, don't know anyone you know?
Yes. So I get people off social media. Our people on our database share our newsletter with their friends and colleagues.
Right.
So we kind of do it that way. And see, to me, when somebody refers one of their friends or associates to me, they're putting their name to Arn. They're
Correct.
going,
Yeah.
hey, Joe, Arn's a good guy. And so they're putting their name to you. And so for me, that even adds an extra level of responsibility.
Sure.
Because not only do I got to perform for the investor, but I got to perform for Joe who referred Rick to me or Sally to me. And the other thing is there is that built-in element of trust. So when I'm talking to a new LP investor, if they already know a friend who's been happy with what I've done, they're going to be open and receptive to what I say. Obviously, they're going to use their own judgment, and as what I'm saying makes sense, does the style of investing I do make sense to them? But it's an easier process to kind of build that connection. And so we really like doing it that way. And we now have maybe 220 unique investors. And Spark is maybe in a little different spot. I'm 70, I'll be 71 here. I do this because I love it and I believe in real estate and I want to help other people benefit from real estate. My two partners are in their 50s, very successful investors on their own right. but we don't have any desire to build Spark into some huge syndication company. If we do 2 or 3 deals a year and they're quality deals, we're happy with that. So we don't need this huge AI driven funnel per se, because, uh, you know, we have 220 investors. We've never not funded a deal. We've always completed every raise. And so it's for us, it's harder to find deals that make sense than to find investors to fund them. So some people may have the opposite problem where they're always finding deals, which of course might lead to the question, how are they finding so many great deals when other operators can't? I mean, when I see somebody come out with a deal every other month, I look every day. I can't find them. There are not that many out there. They're hard to find. So you got to be kind of a little selective.
Yeah. Yeah. So I definitely, I mean, I think that's obviously a great place to be. More access to capital than deals to fund it. I mean, obviously, ideally, you got to get those lines pretty close together. But what I wanted to ask you about, because I think the trust trend, I think would just be useful for everybody to hear. Like, many people are finding sponsors for the first time. Maybe they're finding them on Invest Clearly. Maybe they're clicking on an ad. Maybe, who knows? Maybe they're just Googling. And I'd love to hear for you. Obviously, you've got a really great network, and it sounds like an LP base that really likes working with you. But given that you're out there educating people, probably occasionally you're talking to folks that don't know you. And I would love to just hear your perspective on how, when that trust transfer isn't already in place, like that the referral isn't in place, what is the process of establishing a relationship and building trust with an LP look like in that environment?
Yeah, and I guess maybe another way to phrase your question would be, how does an LP learn how to evaluate sponsors and deals? Would that be kind of a paraphrase? I think that's kind of what you're asking.
Yeah, let's keep it at sponsors for now.
Okay, for sponsors, yes.
Yeah.
Perfect. So, a couple things. For me, I believe to be a successful investor, as a sponsor, I have to have a fairly narrow niche that I'm very good at. I'd rather be deep than broad and shallow. So I think, let me phrase it this way. The right sponsor for a luxury apartment in Dallas, Fort Worth might not be the right sponsor for a heavy lift value add in Charlotte, North Carolina. They're both great markets. So I think as an LP, I would look for sponsors that really have a niche and a sizable footprint in a particular market with a particular type property, because if they own 3 or 4 assets in a market and they're all, let's call them 1980s vintage, and they're presenting a new deal that's in that market that's a 1980s vintage, you can have a pretty good idea they know what they're doing with those 1980 vintage. So I would be hesitant to invest in a sponsor that has a deal in Boise, Idaho, then Phoenix, Arizona, and then Tampa, Florida. I don't believe you have the expertise to do that. So look for sponsors that have kind of a narrowly defined game plan that they perfected and rinse and repeat. So I think that then leads to some level of experience in real estate investing, and also somebody who's been through a few economic cycles. So what's happened in the syndication space, it became widely available 2012. Basically, for 10 years, we had a bull market in real estate. A lot of operators jumped in 2018, 2019, never experiencing a down market. And now the last year or two, we've had a down market and we've seen there's some issues with that. So I think look for operators with some historical track record through a variety of markets because they've been there, done that, and they kind of understand how to better weather those storms that ultimately are going to come. So, and then I think the thing is rely on your gut instinct in evaluating people. When you're talking to somebody, do you feel you're being sold? Do you feel you're being read a script? Or do you feel you're having kind of an authentic conversation with somebody? And that you just have to rely on your life experience. So those would be some of my ideas. But find great operators that have a specialized game plan and they just do it repeatedly.
Yeah. Yeah, that does get to then the deal because obviously some of those specialized game plans also are what are going wrong right now.
Yes,
in some cases.
yeah, and so what I would say with deals that have gone wrong, I would say there've been some common characteristics. So almost invariably, they've been floating rate bridge debt, high leverage debt. We do low leverage fixed rate debt. It's a lot safer. It's a lot simpler. The other factor would be often they were very heavy lift value add deals in very rough neighborhoods. And then the third factor would be often the ownership group, the general partner group was not local. And I think that makes a real difference. So, so when you look at deals that have gone bad, bridge debt, adjusted floating rate bridge debt, heavy value add, absentee ownership, I'd say 2 out of those 3 will be involved in every deal. People who bought property with 35% down and got fixed rate debt, it may not be knocking it out of the park, but you're not in trouble. You're still getting distributions. There's no capital calls. You're doing fine. So there are some characteristics to the deals that went wrong.
Yeah, yeah, that makes sense, and I think probably our listeners are seeing some of that in headlines, or hopefully not in their own portfolios, but likely there as well. So let's go back to the trust piece and communication because I think this is really important. I guess we're kind of like still fairly. I mean, you've been, would you say, 5 years right now syndicating? So still fairly early, and given your strategy, I imagine you haven't had to do this, but like given markets. Right. Things have changed in the past 5 years. So things don't always go 100% as planned. What does transparency in practice look like when things kind of aren't going as planned?
Yeah. So I think, so for me as an LP, and I'm an LP in about 10 deals, I want to know what's going on with my property, good or bad. So I think when an issue pops up, that should be communicated to the LPs immediately. And along with that, what steps are being taken to rectify the matter? So I can tell you about 3 years ago during a heavy storm, we had a tree go down through one of our buildings that knocked out 4 units. Within 48 hours, our investors received an email from us saying, tree down, damage, we've secured the property, we're talking to insurance, etc. So right out of the gate, they knew there was an issue and they knew we were on top of it. Hurricane Helene hit Greenville, not as bad as it did Asheville, but it did hit Greenville. And again, on our 7 or 8 assets, we maybe had 100 trees down. Knock on wood, none hit any buildings, but we had 100 huge trees down. Again, within 48 hours of Helene, we were able to communicate to all our investors over the country who are just seeing stuff on the news, right? They have no idea what's going on. They're worried. We were able to say, hey, Brian and I have driven every asset. We're happy to report no damaged buildings, all residents in place. Yes, we got a tree cleanup, but by and large, we were very fortunate. So I think if there is bad news, put it on the table, let them know what you're going to do to rectify it. And that builds a lot of trust. We acquired an asset November 2024, 1970s build, really heavy lift value add. We're just putting in a new parking lot and driveway, $70,000 job, 38 units. The asphalt company shows up on Monday. They start scraping out the driveway. And lo and behold, underneath the asphalt, there are two huge tree stumps, which we didn't know that were there, that then had to be removed, which of course was an additional cost. So next week we'll send out an update and let them know, yeah, the driveway's underway. It's actually being finished today, but we encountered this problem and there is an additional cost.
Got it. Yeah, well, I think one of the things you just said there is something we're seeing a lot of reviews about, and that's your personal involvement. Like, you got out and drove the properties and you sent an email. And I think that's something that at least we're seeing a lot of chatter about is kind of where is the operator? Is the GP involved? And that seems to be really, really important to people right now. So I think that in and of itself is trust building. All right, I know we're getting a little long here. I just want to see if I have any other questions.
I know I could talk real estate all day, but go ahead.
Well,
I know you got a time limit, so all good.
Well, I'm for me too. I just I want to make sure. I mean, you've got a lot to offer. I want to make sure the listeners get as much as they can in the time that we do have. For folks that are just getting started on the syndication side, I kind of wouldn't normally ask this question, but since you've just done it, like, what advice would you give them about building trust early?
You mean building
GPs?
Well,
People
how
who are
would
thinking about getting in.
build trust? Yeah. So there's an old expression, if it sounds too good to be true, it probably is. So I think as a potential LP, if I'm seeing returns promised, I've looked at 10 deals and this one deal has returns that are significantly better than another, I would kind of wonder what's going on. That makes no sense to me. The other thing would be, we never pressure LPs to make a decision. So I would say if as an LP, you feel you're kind of being pressured to make a decision and invest, that would be antitrust building. I think more to build trust, it's you present the opportunity, you give the investor space to analyze it on their own and sort through and then be available for a follow-up conversation, because the greatest deal in the world will happen again next month, I promise you. So if you feel that pressure, that might be a little bit of a red flag to me, where more, this is an opportunity. If it feels right to you, we'd love to have you on board. And again, invest the minimum. Let us earn your business in the future by doing well. And so that's the approach we try to take.
Yeah, that checks, right? You're partnering with them.
Yes.
Right.
Yes.
It's all in the name, right? General partner, limited partner. So if you were to think about, when you think about the passive investing space, this is a Pat Zingerell question. He loves this. What element of passive investing needs to die, needs to go away?
Yeah. So, I think one, if you're going to be a general partner, learn on your own dime first. And what I mean by that is become a successful investor with your own money. And with that experience and knowledge, now you put yourself in a position where you're qualified to handle other people's money. And so I think what's happened in the passive investing space, people have jumped in without the necessary knowledge and experience of how to actually operate rental real estate. So I wish the business would focus less on marketing and more on learning to do your job and providing some value to people. And the industry is going through a shakeout now because really, uh, uh, in order to succeed in a normal market, you actually do have to have some operational experience and knowledge. You just can't rely on declining cap rates and historically low interest rates. So that's kind of what I'd like to see change. And then the other thing would be, let's stop selling the 2 to 3 year dream. I've been in real estate 40 years. It's created a great life for me, but it didn't happen in 5 years. It may not even have happened in 10. But I would say 10 to 15 years is a more realistic time frame. And I think if as a limited partner investor, if you start taking that, then you kind of understand these line drive base hit deals, not these home runs, not the grand slams, just these line drive base hit deals over time will win the game for you. And so I'd like to see the investing kind of morph more into what traditional long-term real estate investing has been. Flipping apartments every 2 years is not normal. We got to get out of that mindset and return to the more long-term investing. And I leave the listeners with the thought, who are the wealthiest people in America? Who are the most successful real estate investors in America? They're people who have bought real estate for years and just keep acquiring real estate. They're not traders, they're investors with a long-term look. And so I think if we emulate that approach, we have a higher chance of success.
It's a great thought to leave everyone with. In addition to that, let's leave them with where to connect with you directly. So if they want to learn more about Spark and you, where should they go?
Yeah, so appreciate that, Joe. So the website is investwithspark.com, and I'm very active on Facebook and LinkedIn under my name, Arn Cenedella, or Spark Investment Group. So reach out anywhere, and happy to talk.
Awesome. Thanks, Arn.
Thanks, Joe.
Thanks for listening to the Invest Clearly podcast. To find verified investor reviews or to claim your GP profile, please visit investclearly.com. If you enjoyed this episode, please remember to like, subscribe, and leave a review, because that's how other people find the show. Till next time, invest clearly.